program, I'm going to teach you about the 8 rules of the private investor, financial planning, capitalization secrets, what to do next in order to live your dream life in the next 3 months, and your actions and next steps in order to make that happen. Okay. Why do we need to learn financial literacy? Well, the question is not how much you earn, it's about it's about what you know. Okay, because your wealth is a function of how much you know and how long you spend applying it. Okay, simple as that. And then how long you can keep doing that, trying and failing and trying and failing until you succeed before you run out of cash flow. Okay, so the question is not about how much you earn, it's about do you have enough knowledge. Okay, so type a Y in the chat if you understand that. Okay, type a Y in the chat if you understand that you've got to invest in your knowledge. Okay, so thank you. So how does your financial portfolio look? Most people remember their employee and the self-employed side of the loser side of the cash flow quadrant. Okay, those people will basically have a job and they'll be hoping to retire with a pension. Okay, mostly, especially the lower of that 90%. You know, some of them they'll probably, you know, some of them will have ISAs, some will have a mortgage or, you know, whatever, but you know, it's they're not so likely to have shares and all that kind of stuff. Whereas the richer you are, the more balanced you are in where your money is. Okay, and you'll have a portfolio of a lot of different instruments. Okay, your salary won't be the entirety of your where you make money. Okay, so what are the 8 rules of the private investor? And of course, the whole point actually with the last slide is to show you that on the rich side, you have investments. So that's how that's linked. Okay, so we're going to teach you about a little bit about the science of investing. Okay, so type an 8 in the chat if you are excited. Okay, type an 8 in the chat if you are excited. So rule number 1, we're going to teach you about understanding the terminology. What's the difference between assets and liabilities, financial independence and financial freedom, investments and investing? We're going to teach you about the 5 commandments of the private investor. We're going to teach you about financial planning. We're going to teach you about diversification. We're going to teach you about discipline. We're going to teach you about emotions. We're going to teach you about why you always need to learn to both invest and also increase your income. Okay? How long can you spend, remember, before you jump out of the cycle? So, terminology, financial freedom versus financial independence. So, basically, if you imagine that you have expenses of only $1,000 a month, and you know, if you want to go for 10 years, then you basically need $120,000. Okay, so that basically allows you to be financially independent for 10 years, assuming that your cost of living doesn't change. Okay, and who knows what's going to happen? Who knew what would happen this year, right? And so many people are like, you know, can you imagine the people on the left-hand side who are employees or self-employed? Sorry, if you're only catching me doing this, you know, just be aware, it's a loving thing. It's alpha love, but it's an alpha love. Alpha love, alpha loser, but lovingly referred to as losers. We've all been there, okay, where all we knew was have a job. But now, when there's no jobs left, what use is that? Okay. So the other option is to be financially free. And what this means is if you are able to take the same money and invest it into something that is producing $1,000 a month, then actually you can keep all of your capital and live off of the capital. So this is how the people on the rich side of the cash flow quadrant, this is how they live off of dividends or from their portfolio income. They don't think about money. Maybe they got a property that is like bringing in rental income. Okay. Stocks that have dividends, I don't know, other instruments that produce passive income, like our very own CryptoUnit. Okay. So under such a scenario, you could be unemployed for an unlimited amount of years because you always have income. This is about being truly free, whereas this is about being free for a certain amount of time. Okay. And believe you me, I have experience of being this for a while, and it doesn't last as long as you think it's gonna. But anyway, it's all good. It's all good. So what's the difference between assets and liabilities? In fact, actually, before I go on, right, which would you rather be? Would you rather be type an FI for financially independent or an FF for financially free? Okay, what would you prefer to be? Yes, of course it's an FF. Of course it's an FF, Hans. Thank you. And good interaction, guys. Thank you. So assets and liabilities. Again, this was first really popularized by Robert Kiyosaki. Assets, the difference between assets and liabilities. So most people, if you ask most people, they'll tell you that they think that their house is an asset. They'll tell you that, yeah, the accountant would probably write the car off as an asset. You know, it's got saleable value, and so therefore it's got some capital, it just depreciates, right? But actually what Robert Kiyosaki said was, no, your house is not an asset if it is costing you money. It's a liability if it is creating expenses for you. And your car, well, your car needs servicing. You need to tax it. You need to, you know, do all sorts to keep it running. So it's actually an expense. It's not an asset. If you owned a fleet of cars and you rented those cars out and people generated more income for you than it costs to maintain those cars, now you've got a business that is producing cash in rather than cash out. Okay, so that would be how you could turn a car into an asset. And similarly with a house, if you weren't living in it and it's costing you money, but if you have people renting it and you're making rental income, and that is more than what you're spending on the depreciation costs and new lick of paint and home improvements or whatever, building improvements, then actually you now have a business which is producing cash in rather than all being cash out. So you have an asset then. So type a Y in the chat if you understand. Type in fact, more importantly, type an N in the chat if you don't understand. Okay. Okay, I'll take it that that is explained. That's awesome. Thank you, guys. Thank you. So, okay. Guys, do you know what? Seriously, type a whole bunch of 8s in the chat, because type 8 8s just because you're still here. It's amazing. That's for you guys. That's for you. 8 8s, which is an auspiciously magic number. Linford's done 9, which is probably even better. Rowena's done 7, but you did 8 earlier. Alcatel's done, Shahida, sorry, has done 5. Yes, 8. Got 8 from Richard. Guys, great energy. Thank you. Right. There is a difference between investments and investing. Okay. Investments are obviously like investment tools. Okay, there are different tools that you can invest in, including these that you see on the screen right now: bank deposits, real estate, investment funds, precious metal and gems, stocks, forex, all this kind of stuff. They're all instruments, and investing, of course, is the act of getting into them, but it's also the act of getting the knowledge to understand how to get into them. I'm doing some research on gold at the moment because I don't know how to get into gold. I don't know where the best place is to keep it, and you know, how would you sell it, and all of that kind of stuff. Because you know, and so you've got to also invest in your knowledge, right? So investing is also getting the knowledge, okay? And not everyone is going to teach you how to do that. You certainly don't learn about that at school, right? So investing. Let's imagine that you invested $10,000 and over 20 years, if you were doing 12% a year, which is 1% a month, then you'd probably have about $110,000 out of that $10,000. Not bad, an 11x return. If you did it for 24 months, you'd have 10 times as much. Okay, so really, really powerful thing to do to compound your wealth by investing. Okay, type a Y in the chat if you want to get investing. Okay, or type a Y in the chat if you have investments. Type a Y in the chat if you have an investment that is doing incredibly well right now, and that you're excited about the future for it, because I know that I am. Okay. Rule number two, the 5 commandments of the private investor. So commandment number 1 is basically always be saving 10% of your income and compound it. Okay, compounding it is such a magical thing. Okay, because if you're always putting 10% at least into buying more golden goose type assets, golden geese which produce golden eggs, which grow into, you know, which hatch into other golden geese, and so on and so forth, that's compounding. Okay, and then you just got a whole whatever gaggle, I guess it's a gaggle of golden geese, right? So yeah, you've also got to control your expenses. Spend less than you earn. Really obvious. Okay, got to spend less than you earn. Okay, sometimes easier said than done, but do you know what, that is the way that it works. If you can't spend less than you earn, then that's the first task, and then the next task is to understand that however little you do earn, actually you can always take 10%, because even if you have nothing, if you have like $100 a month, right? The difference between living off of $100 a month and $90 a month is really nothing, but compounding that $10 is actually the difference that will free you from that situation. Or you can just spend the entire $100 and you just never change. Okay, it's the habit and the knowledge that is the most important. Type habit or knowledge if you understand that. Okay, habit or knowledge. You've got to protect your money. You've got to learn how to invest it wisely. Okay, and you've always got to learn to earn more. Okay, Hans, yeah, Hans, you meant habit, but yeah, exactly. You've got to have the habit of saving 10%. Thank you. Yeah, habit and knowledge, exactly. So you've got to maintain strict income and expenses control. Back when I was in my 20s and I had a huge amount of debts, and my list of these things was basically all debts. And I was being paid weekly, but I had monthly outgoings. So I needed to be able to track how much money was in my account, so that I knew how much would need to be there, but on a particular date, in order to be able to make it to the next to the next month without going into overdraft and therefore being charged by my bank. Okay, so I did this. I kept a spreadsheet for 20 years, you know, and it looked something like this. This isn't mine. This isn't mine. This is a model one, but you can use this as a model. Okay. So yeah, you track what your income is, what your expenses are. And here is a really, really awesome thing, right? Imagine if you have more streams of income than you have streams of outgoings. Okay, so imagine that you've got more streams of income than you have things going out. Would that be incredible or what? Because most people, their balance looks, you know, basically salary and then a whole list of expenses. Okay. Okay, so there was something else. Yeah, with this you can plan for what you want to spend, and you can track how, you know, so this allows you to then make adjustments. Okay, pretty cool slide. I quite like this one. So rule number 3 is have a financial plan. Lots of different scales of plan. So you can have long-term, medium-term, or short-term plans. Long-term is basically what is the milestone, what is the ultimate goal, okay? What is your ultimate vision for how you want to live in future, you and your family, okay? What is your dream house going to look like and feel like? What is your dream car going to look like and feel like and smell like and whatever? What are you seeing? Are you seeing a family that's going to be free and happy and full of joy and relaxed and at peace? Right? Right. Okay. Thank you, Hans. Yeah. So, you know, what is your long-term goal? Okay. And then what are the milestones that are going to get you to that long-term goal? Okay. So your milestones, these are your middle term. Okay. So your midterm plans are basically your milestones, the milestones that will lead you to your end of life view. Okay. And then your short-term goals are basically how you're going to get to the next milestone. Okay. So type a 1 in the chat if you're learning something. Type a 1 in the chat if you're learning something. That would be awesome. So yeah, so I've just told you about what having a financial plan is, right? Financial planning obviously is the process of actually planning as you're, you know, and keep revisiting your plans, seeing if you're deviating from them, seeing if you want to make adjustments to the plan or make adjustments to what you're doing in order to get you to the thing. You know, your milestones might change, your goals might change. That's all right. But the point is to have them, to know where you're heading. Okay. Next. Okay, so why do you need a plan? Well, because you want to create passive income for yourself, okay? And you need the capital in order to stake, in order to produce the passive income, okay? Can you guys see what Andre is doing with our crypto unit right now? He's always been teaching this stuff, but now he's created something that does it all. It's amazing, right? You know, you can save for your children's education or for real estate or for a car or for opening your own business. You can save and invest in something that's producing a passive income, right? That can basically provide yourself with a pension, that you don't need to be reliant on a pension company, because trust me, all of those they ain't as good as what they sold you, right? And I think we all know that anyway. Inheritance capital for your children, okay? Some reasons why you need that. So, okay, oh yeah, okay, right, yeah, got it. So, don't put all your eggs in one basket. You've got to diversify. So remember the slide that I showed you with the 20 different segments? in our portfolio. So did you notice how diversified they were? Okay. Everything from real estate to crypto to gold to transport to food to insurance, you know, just be diversified. Okay, that makes sense, doesn't it? Type a Y in the chat if that makes sense. Or you can type diversify, right? Being diversified, it's amazing. The best thing you can do. And it's the reason, by the way, why our portfolio pretty much 4x from where we were at the end of last year to where it is now, because we were diversified, massively diversified. Okay. So yeah, wow. So rule number 5, investment discipline. You've got to stick to your plan. There's no use having a plan if you're not going to stick to your plan. Okay, stick to your plan, because there's a reason why you thought out the goal, and now you just got to stick to your plan. But it's okay to deviate and to know that you're deviating and make an adjustment if you have to. The world changes. The world changes. But just have a plan, you know, and pay attention to it and stick to it, you know, unless you're consciously changing it. Don't like deviate and be unconscious about it. That's the point. Okay. Rule number 6, don't be greedy. Okay. This is actually really about managing your emotions. So when things are doing really, really well, it's very easy to be greedy and to overstep the mark. Okay. But greediness is actually what leads to bankruptcy. The other one is you need to get off the mark, because sometimes you can be in fear, and you can have too much fear that you don't actually take action. So you got to take some sort of risk. Okay. Otherwise you're not exposed to the thing that could make you a massive fortune, because you didn't take the risk. So don't be too fearful and don't be too greedy. Okay. So type a B in the chat for balanced. Okay. If you understand. So a B in the chat. Okay. For balanced. Okay. So not fearful, not greedy. Thank you, Shahida. Thank you. Shahida, is it your first time here? Because I don't recognize your Zoom handle there. So I'd love to know. Rowena, I've seen you before. Hans, I think it's the first time that I've met you. Thank you for your interaction, guys. Very, very, very. It's good to have your interaction. Okay. Rule number 7: education, self-development, personal development. So remember, knowledge is the first thing. You need to have knowledge, and then you need to develop a habit of putting that knowledge into action. Okay. And then you need to have enough cash flow such that you can keep doing that and not have to get a job again. Okay. So self-development is the key to success. You've got to invest in your education. So remember, as I said, I am investing in how to do gold, because I don't know how to do gold. Okay. There's a reason to educate yourself, and it is worth the money. Next, rule number 8, always multiply your investment profit. Okay. Create different income streams. You don't want to be reliant on just one income stream. Okay. You want to have lots of different income streams, because that way, if one of them crumbles, then at least you've got all the others. So it's like being diversified again in your cash flow. There's also always be compounding your investments. So if something's doing well, you can compound. Okay. You can take 10% and buy more of it, and take 10%, buy more of it, and so on and so forth, and compound your wealth, multiplying your investment profit. Okay. So that is the 8 rules of the private investor. And next we're going to move on to the 8th wonder of the world, okay, which is basically compound interest, okay. So there is a difference between compounding interest and cumulative interest. But basically, compound interest is exactly what I said, where you take all of your, so you've invested in something, it's now producing passive income, you take an amount of that and you put it back, and you keep putting it back, okay? Because when you do that, that builds the portfolio in the thing. So compound interest, cumulative interest is just basically getting a little bit, like for example, interest on your loan, okay, which will increase with a decreasing rate. And it's all such a con, the banking sector, isn't it? Okay, so financial plan and compounding interest, okay. So imagine that you have that you are able to save 10 euros a month, okay, from a salary of 100 euros a month. If you were to save 10 euros a month from into something that provides 8% every month, okay, by the end of a year, you would basically have turned that 10 euros a month into $204 or 204 euros. After 3 years, you'd have 10 times as much. And after 8 years, you'd have 100 times as much, 1,000 times as much, sorry. Okay, so this is the wonders of compounding your gains. And if you look to the right, let's have a look at this. You know, if you're able to save 50 euros a month and compound that, you could be like a millionaire within 8 years. Okay, so guys, is that good or is that good? You tell me, right? Type good in the chat, that's good. Now we're going to talk about capitalization. So, thank you, Limpid. And Hans, thank you. So, the basics of capitalization. So, capitalization comes from the word capital. So, what does capital mean? Capital is the equity of a company. And net worth is actually, so net worth is what the rich measure their wealth in. And my net worth has shot up dramatically in the past couple of days. It's amazing. I've achieved a milestone, which I've always wanted for myself, and I'm really, really happy. Capital, when economists use the word capital, they use it to mean all the accumulated wealth used to produce additional wealth, which is basically what are the assets that person owns. Assets being things that, remember, bring in passive income. Okay, also known as carrying value or share capital for net worth. Yay! So this slide I love. Okay. So on this slide, basically, if you are able to save $30 a month for 30 years, then you would have, at the end of 30 years, $10,800. Okay? But if you were to take the same $30 and instead of putting it under the bed or in the safe at home, which would generate this $10,800, if you were to put this $30 a month into something that was going to return basically 1% a month, which is 12 months in a year, 12% per year, right? So 1% a month, then actually you would have $105,000 by the end of it, or $106,000 at the end of it. which is 10 times as much as what you would have had if you had have just put it under the bed. Okay. Capitalization of your $10,800, your capital income, is actually $95,000. Okay, so is that good or is that good? Type some more goods in the chat, please. Thank you. So thank you, Rowena. Thank you. And Shahida, thank you. So what will be the savings of Alex and Bob at the end of each term? Okay, right, guys, we've got a game. It's a really nice game here. Okay, so on the left-hand side, you got Alex with a really cool, like, I know, with a really cool throw. And he has saved since 1986, $200 over 30 years. Okay, so over 30 years, he saves $200. Now, Bob gets started a little bit later, but over 20 years, he's able to save double the amount, $400 a month. Okay, so who do you think has the better result? Put an A for Alex or a B for Bob. Who do you think has the better result? Bob. Okay, so Rowena says Alex. Okay, good, good, good. Anyone else? Anyone else? What do you think? Hans says Bob. Rowena says Alex. We've got 1-1 at the moment. I don't know. I don't know if Rowena's cheating, if she's actually already been here. But you know what? It's, you know, if it's a guess, wow, awesome guess, because it's actually true. It's actually Alex that does the best. Okay. So basically, Alex, $30. Sorry, what was it? $200 a month for 30 years is basically $72,000 is what he does, right? But by the sorry, $72,000, and then $281,000 is the capitalization of it at the interest, right? Whereas Bob puts down cash of $96,000, but by the end of it, it's only worth $227,000. So not only has he put more in, his capitalization is worth less, okay, than Alex. So it just goes to show that the sooner you get started, doesn't matter how much, it's actually the sooner and how consistently you do it that actually gets you the result, okay? So be consistent, guys. So the fundamentals of capitalization and the creation of capital income. So I basically already explained this, right? So the capitalization is what the investment is worth at the end minus the actual real cash that he put in, okay? Which is, in this case, $209,000, okay? So here's another game that you can do if you want. So I've actually done this game and it took me 2 days to do, and I actually did it all the way up to 30 years. And I hand wrote it all. So this is my evidence, okay? I hand wrote it all, and trust me, my back was killing me afterwards, right? But it's amazingly powerful when you do this and you're typing the numbers in the calculator and then you run out of numbers on your calculator because there's just not enough numbers, right? And you could do it on a spreadsheet. There'll be some of you that'll be like, oh, why not just do it on a spreadsheet? Well, it's more powerful when you're writing it down because you go through emotions when you do that. But when you are doing it on a spreadsheet, and I know spreadsheets, yeah, it's just not as powerful in your head. So guys, What do you think, right? Let's say that you were to save 100 euros a month and you're able to invest it into something that did 1% a month all the way up to 3% a month, okay? Do you think after 30 years, do you think that if you had managed to put 100 euros a month into something producing 1% a month or 12% a year, do you think you would have $1 million after 30 years? What do you think? In fact, how much do you think you would get? Type that, type a number in the chat. How much do you think you would get if you just take a guess? You don't have to calculate it. You don't have to be right. Just be open to being surprised, okay? So 100 euros a month in something that is producing 1% a month, and you do that for 30 years. How much do you think you would wind up with? Take a guess. What do you think? Because I know I was really surprised when I did it. Oh, guys, there's no guesses, seriously. Well, okay, I'm just going to surprise you then, okay? Is it $1 million? Okay, is it $1 million? Yes or no? What do you think? You've taken 100 euros a month into investing it into something that is 1% a month. Okay, how much are you going to get at the end of 30 years? What do you think? It's got to be more than $100, right? Guys, do some maths. Do some maths. Come on, just have a think in your head. Do you think it? You know, just take a guess. Please take a guess. Please take a guess. How's that? Okay, right. So, okay, look, do you think it's going to be, was that an answer to my previous question? I think it was, wasn't it? Okay, so is it going to be less than, is it going to be more than $500,000? Yes or no? What do you think? Ruin is playing the game. Okay, Tommy reckons it's going to be more than $500,000. Okay. Well, guys, prepare to be surprised. It's actually, you only make about $1/3 if you do that. So 100 euros a month over 30 years at 1% per month yields about $344,000. Okay. But contrast this with 30 years of the same money at 3% per month. Okay. That's actually about $150 million. Okay. What a massive difference 2% makes, right? Okay. That's pretty insane, right? Type an I in the chat if you think that is pretty insane. Okay. I think it's insane. I know which I would prefer to have, right? It is. It is. Okay, so what are you going to do in order to live your dream lifestyle in the next 3 months? What's next? So your actions are basically, you've got to learn and live by the rules of the private investor, the 8 rules. Okay. Share these rules with 5 people, share what you have learned tonight, and keep learning about the financial world. Okay. Start creating your own passive income. Okay. Guys, that's me. That's the presentation. Guys, thank you so much for making it to the end of this webinar. Give yourselves a massive round of 8s for making it this far. And I'm going to give you a bunch of 8s as well. Thank you, guys. Thank you. Thank you. Thank you. And thank you for always coming, especially, you know, Fisa, you're always here. Linford, you're here quite a lot. Richard is always here, you know, and there's others of you as well. You know who you are. right? And I do know who you are, but I'm not going to list everyone. Guys, thank you so much. Thank you so much for being here. And I hope to see you. Come at 7 tomorrow, 7 o'clock tomorrow. I'm going to talk about staking. It's not going to be a PowerPoint. It's going to be something way more interesting than PowerPoints. Okay. So show up at 7 tomorrow. It'll be a different link. It'll be in the chat. Maybe I'll see if I can make it this link actually. Maybe it'll be the same link. So if you've got this link, click on this link. Okay. See, yes, I've seen you before. Hi. 7 p.m. UK time. That's 7 p.m. UK time, Anil. Thank you. Thank you for asking for that clarification. But yeah, I've got some really awesome news about staking, and I can explain it all. And it can be a bit. We'll do it. Oh no! Don't click this link. It'll be a special link. It will be a special link. Look out for it, and it'll be a more interactive thing. Okay. So guys, thank you very much. We're gonna do that for an hour tomorrow, and then we'll jump on the digital doubles one at 8 p.m. Okay. So cool. It'll be, so if you want to know where the link will be, it will be in wherever place that you discovered this tonight, it will be there. Okay. So if you're on the WhatsApp groups, if you're in the Facebook group, and especially if you're in the Telegram group, it will be circulated there. Okay. Guys, thank you very, very much for being here tonight. Nice to see you all. And thank you, and see you tomorrow, hopefully. Okay, bye-bye. Bye-bye. Be excited for the future. 7 p.m. Yes, that's correct. Bye-bye, guys. Bye-bye.